Everyone you know probably thinks the Bitcoin boat has sailed. You see the headlines, you see the price flying past $126,000, and you think, I missed it, it's over, too late. That little sting of regret, that's what the media, the skeptical economists, and maybe even your own family are selling you. They'll point to the charts and tell you the crazy growth is done. They'll say you're buying the top. They are completely and fundamentally wrong. In fact, that little retail dinghy you think you missed, it's being replaced by a fleet of institutional supertankers, and you have a chance to get on board before they truly leave port. You are not late. By the standards of where this is all going, you are still incredibly early. The story of Bitcoin isn't about chasing quick, speculative gains anymore. That was chapter one. We're in a new era now, one defined by institutional buy in, economic necessity, and a technology that has finally grown up. The question is no longer if Bitcoin will be part of the global financial system, but just how big a role it's going to play. So, we're going to tear down that you're too late narrative piece by piece. No hype, no hopium. We'll use hard data and a clear eyed look at the world economy in 2025 to show you exactly why Bitcoin's biggest moves are still ahead. We'll explore why it has become the world's best defense against inflation, who the next big players are entering the space, how a built in supply shock is still playing out, and finally, why a changing world order is setting Bitcoin up to be the neutral reserve asset of the 21st century. If you've ever felt that doubt, this is the breakdown you've been waiting for. It's time to see past the noise and understand the real forces at play. To really get Bitcoin in 2025, you have to start with the silent thief in all of our bank accounts: inflation. It's what makes your groceries more expensive, eats away at your savings, and makes a joke out of planning for the future. For the last few years, the world got a masterclass in how to devalue a currency. Governments and central banks, facing huge economic problems, did the only thing they knew how. They printed money at a scale we've never seen before. That's not an opinion, it's just a fact. The money supply exploded, and the result was obvious. Prices for everything went up. Even though you might hear headlines in 2025 about inflation cooling down, the damage is done. The purchasing power of your dollar is permanently lower. This isn't a temporary blip, it's a reset, and there's no sign this trend of printing money is going to stop. In this kind of world, the hunt for a real safe haven, a reliable store of value, has become the most important mission for any serious investor. For centuries, that was gold. Gold is rare, it's durable, and a politician can't just print more of it to win an election. It's the original inflation hedge. But we live in a digital world now, and a digital world needs a digital solution. This is where Bitcoin has stepped in and earned its title: digital gold. Let's break down why this isn't just a catchy nickname. The foundation of Bitcoin's value is its absolute mathematical scarcity. It is hard coded that there will only ever be 21 million Bitcoin. That's it. No CEO can decide to issue more. No central bank can fire up the printing press. No government can force it to make more to pay off national debt. This makes Bitcoin the hardest asset ever created. We can always mine more gold, but the supply of Bitcoin is fixed. This predictable, transparent system is the polar opposite of the secret, often political decisions made by central banks. When people see their governments running massive deficits, they are increasingly running to Bitcoin to protect their wealth from being devalued. It's a 21st century flight to safety. Even traditional financial advisors who used to laugh at Bitcoin are now telling their clients to put 1 to 5% of their portfolios into it specifically for inflation protection. This isn't a fringe idea anymore. It's mainstream financial wisdom. And unlike gold, Bitcoin has features that make it perfect for today. You can send billions of dollars across the world in minutes with no permission needed from a bank. It's available 24/7 to anyone with an internet connection. And because it's decentralized, it can't be censored. So it's not just a hedge against monetary inflation, it's a hedge against instability in the entire financial system. The market is proving this out. In early October 2025, as the US dollar showed weakness, both gold and Bitcoin rallied, a clear signal that investors are willing to pay a premium for assets that offer shelter from currency debasement. And yes, people will point to Bitcoin's volatility, but they're missing the forest for the trees. Long term, Bitcoin's returns have crushed inflation. The volatility is just the price you pay for getting in on the ground floor of a new global asset. Over time, as more people get in, that volatility is expected to calm down. So, digital gold isn't just a marketing slogan. In 2025, it's a proven strategy backed by data and driven by the economic reality we all live in. People aren't just speculating on Bitcoin anymore. They're buying insurance against the biggest financial risk we face: the slow motion collapse of our currencies. If the inflation hedge is the why, then institutional adoption is the who and the how. For years, we heard the phrase, the institutions are coming, like it was some distant myth. Well, in 2025, they're here. And the amount of money they're bringing is hard to wrap your head around. To put it simply, the game has changed. The days of Bitcoin being driven by retail investors and social media hype are over. This is the institutional era. The smart money, the patient capital, the trillions managed by the world's biggest financial players, they are now the primary force in this market. The big bang for this was the approval of spot Bitcoin ETFs in the United States. Before the ETFs, it was a huge headache for a pension fund or a major corporation to buy Bitcoin. It was a regulatory and logistical nightmare. The ETFs solved all of that at once. They wrapped Bitcoin in a simple, regulated package that these institutions already use for everything else, like stocks and bonds. And that opened the floodgates. Let's just look at the numbers. By mid 2025, US spot Bitcoin ETFs had already pulled in over $152.4 billion in assets. BlackRock, the biggest money manager on the planet, saw its iShares Bitcoin Trust, IBIT, absorb $74.21 million in a single day in October 2025. In just 1 week that month, these ETFs saw total net inflows of $2.71 billion. This isn't just money sloshing around. This is a massive, hungry demand for an asset that is strictly limited. And here's where it gets really nuts. The demand from these institutions is crushing the new supply of Bitcoin. As of October 2025, institutions have bought roughly 7.4 times more Bitcoin than has been mined all year. This is the most extreme supply and demand imbalance I have ever seen for a major asset. When demand outruns new supply by more than 7 to 1, the price really only has one way to go long term. So, who are these institutions? The list is getting longer every day. More than 338 public and private companies now hold Bitcoin on their balance sheets. In total, they hold over 3.8 million BTC, worth around $435 billion. This includes pioneers like Michael Saylor's company, Strategy, which made Bitcoin its main treasury asset. But it also includes a growing number of normal companies in all sorts of industries who are now using Bitcoin as a hedge, just like they would use any other asset. We're even seeing this trend go global, with companies in Japan like Metaplanet following the same playbook. And this is just the beginning. The next wave is already forming: pension funds and 401k plans. New regulations are just starting to open the door for crypto to be included in retirement plans. We're talking about trillions of dollars of slow moving, long term money that hasn't even touched this market yet. When those funds start making tiny 1 to 2% allocations, the pressure on Bitcoin's fixed supply will be astronomical. This is exactly why you hear people like Kathy Wood of ARK Invest talking about prices as high as $1.5 million to $2.4 million by 2030. The whole conversation has shifted from doubt to demand. We are watching Bitcoin get woven into the fabric of the traditional financial system in real time. This isn't a bubble. This is the monetization of an asset driven by the cold, calculated decisions of the world's biggest players. Now, before we get to our third point, a powerful feature built right into Bitcoin's code that guarantees a supply shock. If you're getting value out of this and it's helping you see the bigger picture, do me a favor and hit that subscribe button. We go deep like this every week to bring you insights you won't find anywhere else. Also, let me know in the comments, what do you think will be the biggest driver for Bitcoin's price in 2026? I read all of them. We've covered the demand side of the equation, that tidal wave of institutional money. Now let's flip to the supply side, which is controlled by one of the most brilliant ideas in economics, the Bitcoin halving. If you're new to this, the halving is a simple rule built into Bitcoin's code. People called miners use powerful computers to secure the network, and they get rewarded with new Bitcoin. The halving is an event that happens about every 4 years, where that reward gets cut in half permanently. Think of it like this. In the early days, finding new Bitcoin was easier, but every 4 years, the amount of new Bitcoin that can be created is automatically slashed by 50%. It's the engine that guarantees Bitcoin's scarcity. The last halving was in April 2024, when the reward for miners dropped from 625 Bitcoin per block to just 3.125. A common mistake people make is thinking the price should explode right away. They see the date pass, the price doesn't double, and they write it off. That's a total misunderstanding of how this works. The halving is not an instant event, it's a long term supply shock. Its real effects aren't felt for 12 to 18 months. And historically, this pattern is incredibly consistent. The 2012 halving led to the massive bull run of 2013. The 2016 halving set up the iconic run to nearly $20,000 in late 2017. And the 2020 halving came right before the rally that took us to new highs in 2021. In every single case, the big move didn't start on halving day. It built up over the next year and a half as the supply of new coins dried up. Here we are in October 2025, 18 months after the April 2024 halving. We are right in the middle of that historical window where this supply shock should be hitting hardest. Now, let's put the two pieces together. You have the creation of new Bitcoin being cut in half. At the same time, you have giants like BlackRock buying up way more Bitcoin than is even being created. This is economics 101. It's a guaranteed squeeze. The amount of new product on the shelf was just cut, while the number of rich buyers has multiplied. Some critics will say that because Bitcoin's inflation rate is already pretty low, the halvings don't matter as much anymore. That's technically true, but it misses the bigger picture. The halving acts as a recurring global advertisement for Bitcoin's main selling point, scarcity. Every 4 years, the whole world is reminded that Bitcoin's supply is fixed and its rules don't change. This strengthens the digital gold story and pulls in a whole new wave of investors. So when you look at Bitcoin's price in 2025, you have to understand it's not happening in a vacuum. It's the delayed but powerful result of a supply shock that was hard coded into the system years ago. The squeeze is on. We've covered the internal forces driving Bitcoin's value, but to see the really big picture, the multi-decade potential, we have to zoom out and look at the global chessboard. The fourth, and maybe the most powerful, reason to own Bitcoin is its emerging role as a neutral, apolitical reserve asset in a world that is breaking apart. For about 80 years, the global financial system has run on the US dollar. This gave the United States an exorbitant privilege. It could run huge deficits and control the financial system. But the world is changing. We're moving from a world dominated by the US to a multipolar world with many centers of power, like China, Russia, India, and other emerging nations. In this new reality, relying on one country's currency is becoming a huge problem. Countries are actively looking for alternatives to the dollar. This de-dollarization isn't a conspiracy theory, it's a stated goal for many nations. So, what's the alternative? The euro has its own issues. Nobody fully trusts the Chinese yuan. Gold is a classic choice, but it's clunky and hard to move around in a digital age. This is the void that Bitcoin is perfectly designed to fill. Bitcoin is the world's only truly neutral, global, non sovereign store of value. It's not controlled by any country or corporation. Its rules are math, not politics. This makes it an incredibly attractive asset for central banks that want to diversify away from the dollar without just becoming dependent on another country's currency. By holding Bitcoin, a nation can store value in an asset that's outside the control of any geopolitical rival. It's a hedge against sanctions and the weaponization of finance. We're still in the very early days of this, but the signs are there. We see reports of nations quietly adding Bitcoin to their strategic reserves. The US itself has talked about creating a sovereign wealth fund that could hold digital assets because it knows it can't be left behind. And it's not just happening from the top down. For millions of people in countries with runaway inflation and unstable governments, Bitcoin isn't an investment, it's a lifeline. It's a way to protect your savings from being erased. It's a way to receive money from family abroad without getting ripped off. It's a way to plug into the global economy on your own terms. This dual adoption, from the top down by institutions and from the bottom up by individuals, is what makes Bitcoin so resilient. It's becoming an institutional grade asset for Wall Street and a freedom tool for Main Street in Buenos Aires at the same time. This isn't just about the price going up. This is about Bitcoin maturing into a critical piece of global financial plumbing. When you invest in Bitcoin, you're not just buying an asset, you're buying a piece of that future. Now, no honest conversation about Bitcoin is complete without talking about the risks. It would be wrong to pretend this is a guaranteed easy ride. This is a revolutionary technology, and that comes with volatility and unknowns. So let's be real about them. First, volatility. As we've seen recently with drops below $110,000 after hitting new highs, the price can swing wildly. There will be 20%, 30%, or even bigger drops. That's the price of admission for an asset with this much potential. It's a feature, not a bug. It means you need to have a long-term view and the stomach to hold on. But if you're looking for smooth single-digit returns, this isn't for you. Second, regulatory risk. While the trend is toward clearer rules, a surprise crackdown or new taxes in a major country could still shake the market. We've seen how new regulations in Europe have impacted the market, proving that these things have real consequences. A coordinated global ban is almost impossible now that institutions are so involved, but the risk of bad policy is still there. Third is tech and security risk. The Bitcoin network itself has been bulletproof for over 15 years, but the ecosystem around it, the exchanges and apps, can be weak points. The phrase not your keys, not your coins is critical. If you leave your Bitcoin on an exchange, you're trusting them not to get hacked or go bankrupt. Real ownership means controlling your own keys with a hardware wallet. This takes a little more responsibility than a traditional investment. Finally, there's always the risk that a new technology comes along or that the digital gold story just doesn't play out. No future is certain, but you have to weigh these risks against the massive potential and the powerful forces we've discussed. In my opinion, for a long term investor, the institutional adoption, the economic tailwinds, and the built in scarcity far outweigh the risks. The key is to be educated, know what you own, and don't invest more than you can afford to lose. So, let's wrap it all up. We started with a simple idea: you are not too late. What feels like the end of the line, the price blowing past $126,000, is really just the end of the beginning. We've shown how Bitcoin has proven itself as the best inflation hedge for a digital world. We've seen the undeniable proof that institutional capital is here, buying up Bitcoin faster than it can be made. We've understood how the supply shock from the 2024 halving is creating a massive economic squeeze that has historically sent the price soaring. And we've zoomed out to see Bitcoin's place on the world stage as a neutral asset for a new multipolar era. When you put all four of those pillars together, the conclusion is clear. The investment case for Bitcoin isn't weaker at these prices. It's stronger and more data driven than ever. The risk has gone down as institutions have poured in and regulations have become clearer. The little boat from the last decade was just the scout ship. The fleet of supertankers is just leaving the harbor. Analysts are throwing out price targets that sound crazy, from $135,000 to $200,000 by the end of this year alone, with long-term forecasts from respected names like Cathie Wood pointing to a multi-million dollar price per coin in the next decade. The big takeaway is this: Bitcoin investing has changed. It's not a wild gamble anymore. It's a strategic investment in an emerging global store of value. You're not betting on a startup. You're investing in a monetary network that's becoming part of the global financial foundation. You're still early. Now, I want to hear from you. Did this change your perspective? What's your price prediction for the end of 2026? Drop it in the comments below. Let's talk. And if you want to keep cutting through the noise in the world of digital assets, make sure you subscribe. Thanks for watching.